On today's episode, we are going to take a look at Tencent and overall Chinese stocks right now. They're taking a big sell off, but the main culprit has to be Tencent. So, in today's episode, we're going to take a look at why this sell off is happening. We're also going to see, is this a buying opportunity? And I'm just going to share my overall thoughts. If this is your first time here, make sure to hit the subscribe button. Don't forget to hit the thumbs up and follow me on Twitch where I live stream, taking a look at stocks you want me to look at. So let's get started. But before we begin, let's take a listen to today's sponsor. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. Alright, so the company we're mainly going to take a look at today is Tencent, but we're also going to look at some other Chinese stocks that are getting hit hard. So Tencent is traded over the counter as ticker TCEHY. It's currently sitting at $78.20, and it is down about 7.6% while I'm recording this video. From its all-time high, the stock is down about 20%, but for, let's say year to date, the stock is up about 7%. Right now, Tencent, for those that are not familiar, it is a holding company. So this is pretty much just a huge portfolio. They buy different companies and they kind of include them in their revenue guidance. They help these other companies grow. They work with partnerships. And most of the holdings they work with are usually Chinese-based companies. So to me, Tencent is one of my favorites in the China market because it allows me to have some form of exposure in China and not having to pick individual stocks, right? Because I'm kind of diversified if one buys Tencent. For example, let's take a look at their most recent revenue year for fiscal year of 2020. Their revenue segment is broken down into the following. 23% of their revenue comes from social networks. 32% comes from online games. 17% comes from online advertisement, and about 27% comes from fintech and business services. In their business services, they also have Tencent Cloud, which is one of the top 10 market shareholders in the cloud space. So that's also pretty impressive. Some of the names, for example, in the communication and social, they own WeChat, which is very big in China, QQ as well. They own numerous media and content providers. For example, Huya and Doyu, which are live streamings we're going to see. And in the video game industry, they own the creators of League of Legends. They own a good portion of PUBG, of Peacekeeper Elites. These are some big names out there. They also own, for example, about 30% of Sea Limited, which is a big Southeast Asia e-commerce market that is growing like crazy. So we can see, right, they definitely have their foot in different markets. And because of all these companies, they're able to partner really well with each other to help each other grow. So now that we understand a little bit about Tencent, let's try to see why this sell-off happened. And the sell-off is happening because Tencent's biggest investor cashes in on pandemic rally. Tencent stocks falls nearly 10% after the largest shareholder plans to sell $14.6 billion. That's a huge amount, right? It's definitely something to be worried about. But how much money is that really compared to their position? So first, let's try to find out who this investor is or who their top owner is. Their top owner is Naspers as their most recent earnings, and they own 31% of the business. Naspers is the parent organization to this company called Prosus. Prosus right now is another holdings company, and they are the biggest shareholders of Tencent, like we saw. This is traded over the counter as ticker PROS.Y right now, and these shares are down about 4.8%, almost 5% for the day after this news released. But But I don't believe the sell-off is they're selling a huge amount, right? 14.8 billion or whatever the number was. I wish I had that kind of money, but I don't think it's that dramatic to be seeing. I think it's more of just a volume that's happening right now that's causing this sell-off. Because if we take a look at this, like I mentioned, Prosus owns about 30.9% of the business. After this sell-off happens, they're gonna own 28.9%. So they're not really decreasing their stake by much. It's such a small number. And I mean, it makes sense, right? You need to sell some of your winners. Sometimes it's smart to trim off, and that's what Prosus seems like they're doing, right? If right? Let's say you have a great stock that has done amazing and it makes up a good portion of your portfolio. You own such a big portion of it. Wouldn't it make sense to at least trim off something to kind of use that to either build up cash or to go into another position, right? We can see Prosus is not intending on selling a majority, barely a few percentage of its ownerships. So to me, that is not a reason to really be worried about Tencent or any other Chinese stocks. I do believe this might be giving investors who want to enter into this market some form of buying opportunity. At the same time, I do have to remind you, right, these are Chinese stocks, and Chinese stocks tend to be a little more risky in the form of investors, right? They believe China stocks are more risky just because of the government regulations outside of the United States, and just the type of control their government has. And that's why the stock price has been kind of lagging the past few months. Even though Tencent, I believe, is such a strong leader, there is that risk. I personally do invest in Chinese stocks, but I limit my exposure. I would never go over, for example, I think 18-20% is the max I would ever own in that Chinese international market. I wouldn't mind holding in other markets a little bit more, but the overall China market, that's as big as I would go. And at the moment, I don't even think it's that big. I think probably it's about 10-11%. Another stock that is down pretty big, and I'm just going to share my thoughts on it, is Huya. Huya is down to $18.47, is down 5%. Huya is actually owned 47, almost 48% by Tencent. So again, this liquidation just continues to happen in the overall Chinese stocks right now, it seems. From its all-time highs, Huya is down about 45%. Huya is one of my favorite stocks just because I believe live streaming platforms is going to continue to grow. In 2020, Huya was a tier 1 stock for me, one that I added a nice amount. At this moment, I just don't have the funds to continue to add, but Huya definitely looks very, very enticing to me. Next, we have Doju. Doju is very similar to Huya. They're planning on merging. Tencent owns about 37.5%. Again, this Doju I don't have a position on. If I had a position in any of these, like I do on Huya, no intentions of selling Huya, no intentions of selling Tencent. If I wanted to increase my exposure, I do believe now is a perfect time for there. Another stock that I wanted to take a look at was TIGR. TIGR is a fintech company. Most of it call it a form of like Robinhood of China. This one is not owned by Tencent, but I just want to show that the overall Chinese market is kind of taking a huge beating right now. This one is down 9%, and it is down about 54% from its all-time highs. So that's it for today's episode, right? We can see it's definitely, I can understand why the sell-off is happening. I just don't think it's a reason to be selling stocks right now, right? People need to take some time, take some of their winners, trim off some of their winners, and just build up a small cash position. And that's what Prosus seems to be doing. But I do believe now seems to be a nice time to increase that exposure if you want to grow in the China market exposure. At the same time, there's always tons of risk, especially investing in a company in countries like this, right? So I hope you guys enjoyed today's episode. Like always, take care, have a good night, and see you next time.